Hello, I'm Tammy Green, and this is your Week in Forex from MaxiForex. Today we will review last week's market highlights. Greece's bonds are beginning to trade, but are failing to reduce borrowing costs. Europe's rescue plan for the suffering economy seems to be questionable, and they may be heading back to square one. The IMF and the EU bilateral loans are likely. The U.S. has seen the greenback climb to a 7-month high against the yen, as employment figures seem to be positive for the United States. Now we will discuss these and other hot topics with financial analyst Martin Smith. Welcome, Martin.
Hello, Tammy.
Well, Greece's 7-year bonds have started trading, but they're failing to actually reduce the borrowing costs for Greece. What does this say about the only 1-week-old rescue plan that's been put in place?
Well, quite simply, it may need to change. So far, Europe's rescue plan has failed to do what its leaders had originally predicted, reduce borrowing costs for the region's most indebted country. Now, the yield of 10-year Greek government bonds has increased 25 base points since the EU leaders agreed to the aid blueprint on March 25th. Now, they were hoping to set up an agreement that would essentially never have to be used. Now it appears that they're heading back to square one.
So borrowing costs for Greece are actually increasing?
Yes, and the risk that EU leaders are coming again to a junction where they must flesh out another rescue mechanism for this sinking economy. Now, this again points back to the big argument we've discussed over the past few weeks that has gone on between Germany and France. Now, if German Chancellor Angela Merkel has to counter public opinion and fund a bailout for Greece with taxpayers' money, well, it may not be pretty.
So what would be the trigger for the IMF to actually step in?
Well, if Greece runs out of fundraising options, then a combination of IMF and EU bilateral loans is likely. The Greek Prime Minister has to raise up to 11.6 billion euros by the end of May. Now, most markets don't believe that Greece will see this through, although many strategists say that it's far too soon to say that the EU has failed with their plan to steer Greek bonds lower. Some are chalking it up to the belief factor.
Well, interestingly enough, the greenback has actually climbed to a 7-month high against the yen. Can you explain what's going on here?
Well, Friday's payroll data showed growth in the US labor market. It seems that the US economy is recovering sharply. You see, as long as there exists some ambiguity over the timing of the Fed, the data tends to be positive for the US dollar.
What about US employment?
Well, initial jobless benefit claims in the US declined by 6,000 to 439,000 in the week ended March 27th, bringing the average over the past month to the lowest level since 2008, according to Labor Department data. And the figures were in line with economists' forecasts, and on top of that, US employers added 184,000 jobs last month, in the biggest gain in 3 years.
There seemed to be some good news for the UK economy this week. Could you tell us a little bit about that?
Well, in the fourth quarter, Britain emerged from the recession at a much faster pace than expected. Gross domestic product rose 0.4% from the third quarter, compared with the previous calculation of 0.3%. And the median forecast in a Bloomberg News survey of 28 economists was for a 0.3% increase.
What does this mean for the political climate in England?
Well, Prime Minister Gordon Brown, of course, has been counting on an economic revival to deny the Conservatives a majority in the election he has to hold by June. The ruling Labour Party has narrowed the Conservatives' opinion poll, led by arguing that opposition plans to start cutting spending this year risk plunging Britain back into recession. It's good that it's reinforcing the perception of recovery, but it's still fragile and dependent upon monetary and fiscal policy.
Could you give us some technicals this week for the euro-yen?
Right. Well, the cross is broken and closed above the 125.20 level, which is a very strong and bullish signal that may lead the cross to another rally. As long as pullbacks are limited to the 125.20 level, its breakout remains valid. Now, the bigger challenge for the cross is the 126.96 level, its February 3rd high. Here we expect a halt to occur, thereby turning it lower. However, if that level fails to hold, a move further up should lead towards the 128.35 level, its January 26 high. Now, its daily RSI is supportive of the current upside offensive. However, alternatively, to reverse our bullish view, a break and hold below the 125.20 level must be established to create a scope for further downside movement, which will lead towards its March 29th low, and then the 121.03 level, which is the March 22nd low. So on the whole, having violated the 125.20 level, further upside risk points higher towards the 126.96 level, and even possibly higher than that.
Well, thank you, Martin, for your very detailed analysis. Until next week, I'm Tammy, and be sure to visit us at maxiforex.ru.